John Ulzheimer is known as one of our nation's most recognized credit experts. Having worked for 28 years in the credit industry, John has become one of the most prolific speakers about credit and the go-to authority on answers to credit-related questions. Credit Countdown with John Ulzheimer.
Hello, my name is John Ulzheimer, and I'm a consumer credit expert. This is my 30th year in the credit industry. I have spent time at FICO, which is the company that invented and manages and maintains the FICO credit scoring system. Probably heard of that. And I also spent time with Equifax Credit Information Services, which is obviously one of the 3 generally recognized national consumer credit agencies. So today's question, it's actually really a good one because it's one of those ones that has a lot of minutia. If I don't answer it with really precise wording, then it might cause some confusion. The topic today has to do with credit scoring, and it has to do specifically with whether or not your age can factor into your credit score. First off, is your age on your credit report? And that's important because only information on your credit report can factor into your credit score. If information is not on your credit report, then it is impossible for it to factor in your credit score. Credit scoring systems only consider data exclusively that appears on your credit report. Your age is on your credit report. Why? Because your date of birth is on your credit report, so it would not be that difficult to determine how old you are by looking at your date of birth relative to the current date. So A, the information is on a credit report, meaning that it could be seen by lenders and any other program or system that reviews credit report information. That's number one. Number 2, is it even legal to consider someone's age in a credit score? I know every single one of you had just answered no out loud, and you're all incorrect. It is absolutely legal for your age to be considered not only by lenders, but also by credit scoring systems. And let me draw a real-life example for your comparison so you can understand that age is something that can be considered. Think about when you applied for insurance for your car and you were 17 or 18 years old, your insurance policy, or assuming that your insurance premium was higher because of your age, because you were young, and younger people obviously are not as responsible and they don't have as much experience as someone who is much older. And so therefore your premium was higher. So the entire insurance industry considers your age. And so it's not an offensive thing because it has been done for so long that it's almost become accepted. In consumer lending, it's a little bit different. The Equal Credit Opportunity Act, which is essentially what sets the rules with respect to what can and cannot be considered by lenders, absolutely will allow for a credit scoring system to consider your age. That doesn't necessarily mean that it happens. And so it's the difference between, is it legal for it to occur versus does it actually occur? And there's a very, very different standard there. It does not occur. And the reason it does not occur, well, there's 2 issues. Number one, it would be a PR nightmare. Can you imagine any bank or credit card issuer telling their applicants, well, we denied you, and one of the things we considered was your age? That would not go over well. It would be horrible PR for something like that to occur. As far as credit scoring goes, the consideration of your age in a credit score is legal. However, because of the ECOA, it cannot be considered the same way, say, for example, a late payment can be considered or your credit card debt can be considered. The issue has to do with protected classes of people. And as it pertains to age, there is a protected class, and that class is referred to as, quote unquote, the elderly. This is not a John Ulzheimer word. I didn't come up with that term. That is a term that is straight out of the Equal Credit Opportunity Act. And so I'm just basically repeating the term as it comes out of the act. The elderly is a protected class. And because they're a protected class, if you were to consider their age, you would have to ensure that they are not penalized in any way in a credit scoring system because of how old they are. So what that essentially means is that you would have, when you're building a credit scoring model, if that scoring model was to consider someone's age, you would have to force the model to assign the maximum number of points that are up for consideration based on your age. So someone who is not in the protected class, like someone, say, for example, like who's 30 years old, that's not considered the elderly. They could score high or low based on their age, and there's no issues as long as the consideration of the age actually makes empirical sense. And so hypothetically, if someone was a higher risk because they were younger, which there's really no research that indicates that. In fact, there's research that indicates the exact opposite, that some groups of young people are actually much better credit risks and managers of their credit than people who are, say, my age, in their late 40s, early 50s. So it's not necessarily what you would assume or presume, like how it operates in the insurance world, where your age really does indicate that you're higher risk if you're younger, and as you get older, then you're considered lower risk. As far as people managing credit, it's not that clean. It doesn't, being young does not equate to high credit risk, and being old does not equate to low credit risk. It's not that simple. Because of the issue of assigning or being forced by the ECOA to assign maximum points to someone who is in this protected elderly class, you could actually be forcing the model to do the exact opposite that the data suggests how it has to consider someone's age. And so because of that and the PR issues, your age, even though it is legal to consider, it is not considered, even though it is on a credit report and could theoretically be considered because the data is present and is reliable. So I know that's a lot of moving parts to that issue, but one of the, I guess, a good trivia question that I always ask when I go and do presentations about credit scoring is, raise your hand if you think your age is legal or illegal, or legal to use in the overwhelming majority of people, unless they have a deep understanding of the Equal Credit Opportunity Act, immediately knee-jerk react and say, oh, it's illegal. You can't decline someone because of their age. And the answer is that it can be considered, but you have to consider it per the guidelines of the ECOA. So I hope I answered your question. Thank you very much for taking the time to watch. If you have any comments, please leave them in the comment section below, and we'll speak again soon. Thanks a lot.
For more videos and credit tips from John Ulzheimer, go to www.tradelinesupply.com.